Wall Street bouncing back. U.S. markets rallying to regain almost half their losses from the day before, when stocks took the largest plunge in 6.5 years. That is the percentage loss that we saw on the Dow. The Dow ending the day with a gain of 567 points after closing down more than 1,100 points on Monday. Futures right now are showing losses across the board, 243-point loss on the Dow futures. Despite the turbulence, Treasury Secretary Steve Mnuchin telling lawmakers on Capitol Hill that the markets are functioning, quote, very well.
We are very focused on the long-term economic growth, and we believe that the policies that we've enacted, including tax reform, are very positive for long-term economic growth. We're already beginning to see that in terms of corporate investments back into the United States and the impact on corporate earnings. I think, as you said, the stock market is up significantly, over 30% since President Trump was elected. We're monitoring the stock markets. They're functioning very well, and we continue to believe in the long-term impact of the stock market.
Lindsey, your take on what Secretary Mnuchin is saying, but also, is volatility going to threaten this 9-year-old bull market?
I think volatility certainly has a shot at ruining it. But look, last year there were 8 days that we saw a move of 1% plus or minus on the S&P 500. Historically, we usually see about 50 of those days. And when you have a year like that, the next year you're bound to have more volatility. So I think people should buckle in and get ready for more of that.
What I was referencing is, again, it was this sense of calm leads to overconfidence among individual investors and professional investors, that people kind of become delusional about their ability. And you had all these bets on stable markets, these inverse volatility. These were exchange-traded retail products, 2 of which, including the XIV, closed down to investors after they lost most of their money late Monday. So again, these losses, the tide goes out and you see who was swimming naked.
Well, I won't comment on the swimming naked, but what I will say is we've realized financial engineering doesn't always work, and program trading, sometimes the pendulum goes too far each way and you have these type of swings. My concerns are twofold. One, I think the administration is talking way too much about the stock market. I think President Trump, I think he should take a lot of credit for the rally, but to talk about it literally every day, it's not the gauge on the economy we should be using, as 50% of the nation doesn't even own stocks.
Well, I've been saying that literally since he took office.
Well, that's where I took it from. And I think, secondly, I think that I know, as the oldest one on this desk, I have not been in a market that we've seen this type of backup in rates starting, inflation feeling, protectionist environment, problems with the fiscal deficit on one side, and then the other side, decent growth. You have the tax cuts that are going to be, almost like its own quantitative easing. And then lastly, good corporate profits. There's a real tug of war that's going to go on in 2018.
Well, who's going to win? Because I will push back, because I've been concerned about interest rates moving up since really the end of last year, but with inflation now coming, with wages now growing at close to 3%, which was happened in the most recent month. That's still, wages are still, growth is still very muted. Inflation is still muted. And all the signs in the market, for the most part, do say that the economy is okay, if not great.
So I would say, first of all, I would say the bulls will win short term, because the tax reform is going to be the sugar candy for corporate growth. And I think you're going to see that short-term, stock buybacks, dividends, some M&A activity. But I think long-term, people are going to project out a backup of rates. And when we start getting, 3.5%, 4%, you're going to see a shift take place, from equity to fixed income. You're just going to see it, because risk-free returns are going to start to look good versus a market that's been pretty buoyant. I mean, that's just one thing I do have is experience 30 years. I can't say I'm much in the market today.
But it sounds like you're calling longer term for a bear market in stocks and bonds, because again, because we've had a bull market in bonds since the early 80s.
I wouldn't say a bear market, but I think the bears will beat the bulls probably come towards, late 18, early 19, as we see, and just in my opinion, this nervousness. We're going to do better. Growth is here. Wages will do better. The labor force is starting to tighten. Those are just facts. And we have a whole new Fed environment with, Powell coming in.
I think it's going to depend largely on inflation and interest rates as well. And inflation is going to be driven by that wage number. If we get productivity, which it seems like we should get better productivity, the inflation won't come in high-speed manner that is sort of expected by the market right now.
Any concerns about the impact to the economy because of tax reform if the Fed ends up tightening up monetary policy because of inflation, as some are talking about right now? And ultimately,
well, they are tightening monetary policy. They're
right.
reducing their balance sheet. It's already down to $4 trillion, and they're already
right. But the question is,
rates.
if interest rates, if we get 4 instead of 3, if things change as they are trying to cool down the economy, getting too heated up, do you have any concerns over the tax cuts and how that might have an impact on the deficit and the debt?
Well, I do. I mean, I've been speaking about it. Yes, I'm a pro-growth Democrat, but I'm fiscally pretty hawkish in the sense that I think everything should have been revenue neutral. I believe in the pay-go system. And so my view is, although I was supportive of tax reform, I probably would have looked to have done, I would have.
So you were concerned.
I was concerned on the fiscal side big time.
So you were also concerned when the national debt doubled under President Obama.
Absolutely.
Did you tell him that as his economic advisor?
We're talking about what we're looking. The answer, I've been with you for a decade, so the answer is yes. I mean. Listen, when I was his economic advisor, very clear we want the tax reform to go to 28% for corporates, 25% for manufacturing. We were also, we had a Republican Senate and House. It had to be revenue neutral. That was the only dialogue we ever had was revenue neutral. That being said, corporate tax reform is a good thing. I am not going to push back on that. I just think that we have not been in an environment with raising rates, high debt, fiscal deficit, and think that's good for the stock market.
And I agree with you that we've never been in an environment where the Federal Reserve, we had such easy money for so long that we're entering this unprecedented era of where the Fed has to unwind this balance sheet, where the easy money starts disappearing and you're just beginning to see the risky, even idiotic bets that people took because everything was going up in lockstep. I want to get to this, though, Lindsey, just to mention that the Atlanta Federal Reserve did lower its first quarter GDP forecast to 4% from 5.4%. That was what it released last week. The change in the space of a week, what do you make of it?
I mean, it was related to consumption and fixed investment. So I think consumption is still good at 3%. We saw 3.8% in the fourth quarter. The consumer is very, very strong. And 4%, let's be honest, when was the last time we saw 4% GDP growth? That's an outstanding number. And the Atlanta Fed has been pretty decent with the accuracy for the initial estimate of GDP.
We should ring the bell if we have 4% GDP.
Thank you. And we're getting that 4% in part because of the tax reform.
Yes.
There you go. See?
We all agree. 2 for 2.
We all agree.
We don't have to worry about that deficit if we continue to get 4%.
Again, I worry about, I've said this repeatedly, but like you saw all the speculation going on in like Bitcoin, in these assets, speculating with these exchange-traded products on stable, low volatility markets. And you get a snapback and you see what kind of risk people were taking. I don't think that this clearly is not over with the loss on the futures this morning.